Imagine waking up one morning to discover that your bank has been quietly withdrawing a small amount of money every single day for years. The individual withdrawals are so small that you rarely notice them, yet when you finally add them together, the total is larger than a year's salary. Most people would call that theft, demand answers, and immediately look for a way to stop it. Yet there is another kind of financial drain that works in a remarkably similar way, one that almost everyone experiences, one that appears on no bank statement, arrives without an invoice, and often grows larger the longer it goes unnoticed. It is a hidden tax, not in the legal sense collected by governments, but in the economic sense of invisible costs that steadily reduce purchasing power, delay wealth accumulation, and shape financial outcomes without asking for permission. Understanding this hidden tax begins with recognizing that money is never standing still because every dollar is constantly interacting with time, prices, opportunity, and human behavior. When people hear the word tax, they usually think of income taxes, sales taxes, or property taxes because these are visible deductions that can be measured with precision. Hidden taxes are different because they emerge from the structure of the economy itself. They appear whenever money quietly loses value, whenever delays become expensive, whenever high costs force people into even higher costs later, or whenever financial decisions create consequences that are not immediately visible. These invisible costs rarely feel dramatic on a single day, but over years they can reshape entire financial lives. That is why two people earning similar incomes may experience completely different financial futures, even when neither believes they are making major mistakes. One of the most powerful hidden taxes is inflation. Inflation is often described as rising prices, but psychologically it feels much smaller than it actually is because people compare today's prices only with those from a few months ago, rather than over decades. Imagine someone keeping $10,000 in cash for 20 years, while prices increase by an average of 3% annually. The number printed on the banknotes never changes, yet the amount those dollars can buy steadily declines. The loss is gradual, making it almost invisible, but mathematically the purchasing power has been significantly reduced. Nothing was taken directly from the account, yet real wealth quietly disappeared because the money remained still while the economy continued moving. Opportunity cost creates another hidden tax that many people never calculate. Every financial decision includes not only what money buys today, but also everything that money can no longer do tomorrow. Spending $100 on an impulse purchase is rarely just a $100 decision. If those same funds could have earned modest long-term returns, the future value becomes much larger than the original amount. The true cost therefore includes both the purchase itself and the growth that never had the opportunity to occur. This explains why seemingly harmless habits repeated consistently can produce surprisingly large long-term differences. Behavioral economics adds another layer to these hidden taxes because the human brain evolved to prioritize immediate rewards over distant benefits. Psychologists call this present bias. Receiving pleasure today feels more emotionally valuable than receiving a larger benefit years later, even when the mathematics strongly favors waiting. Businesses understand this tendency extremely well, designing products, subscriptions, payment systems, and purchasing experiences that reduce the psychological pain of spending while increasing the likelihood of repeated consumption. Individually, these decisions feel insignificant, yet collectively they can become an invisible stream of financial leakage that continues for decades. There is also a hidden tax created by financial stress itself. Research in behavioral economics has shown that scarcity changes the way people think, narrowing attention toward immediate problems while reducing the mental resources available for long-term planning. Someone facing constant financial pressure may have less capacity to compare prices, negotiate contracts, plan investments, or prepare for future expenses. The result is not simply emotional discomfort, but a measurable increase in costly decisions, creating a cycle in which financial pressure itself becomes another expense. The economy, therefore, does not affect only wallets. It also influences the quality of decisions people are able to make. History provides many examples of these invisible forces. During periods of sustained inflation across different countries, households that understood purchasing power often adjusted their financial behavior earlier than those focused only on nominal income. The difference was not necessarily intelligence or luck, but awareness of how economic systems gradually transfer value over time. Those who recognized invisible costs sooner generally adapted sooner, while others realized the impact only after years of declining purchasing power had already accumulated. Perhaps the most important lesson is that hidden taxes are rarely eliminated entirely because they are part of how modern economies function. Inflation, opportunity cost, transaction costs, delayed decision-making, and behavioral biases will continue to exist regardless of individual preferences. The meaningful difference comes from recognizing that these forces are always operating in the background. Once they become visible, financial decisions begin to change because attention shifts from the price of an action to its complete long-term cost. The next time a purchase seems inexpensive, or keeping cash feels completely safe, or delaying a financial decision appears harmless, it is worth asking a different question. Instead of asking only, "What does this cost today?" ask, "What invisible cost might this create over time?" That single shift in perspective may not eliminate every hidden tax, but it changes the way financial systems are understood. And in economics, understanding the system is often the first step toward making decisions that better reflect how money actually behaves over time.